Welcome everyone to the Pump and Dump channel. Today I would like to look at a gold mining exploration company out in Mali. It's called African Gold Group. It's a very interesting project that they have. We can see here on their main page of the website they have a presentation from May 2019 and a feasibility study from 2016, which will be the cornerstone that I use for this analysis. So looking at the presentation, we can see here that they talk about having a $2.2 million 2.2 million ounce mineral reserve. They are targeting to increase its production potential to 100,000 plus ounces per year. There's some things like mergers and acquisitions in here that are really of no relevance because we don't want to look at that at the moment because this is all speculation. More importantly, they talk about here having a clear strategy for growth and adding shareholder value, which will come out of exploration and a new technical study from what I've read in their presentation. Looking at the management team, they have Stan Barty here. He is an engineer and geologist. He's also the current CEO as of 1 or 2 months ago. He's been very successful. He has a net worth over $1.5 billion. Someone you would like to bet on having success because he's done it in the past. And then there's some other people here that I do not know who they are. I have no idea. It doesn't really matter to me. But the key thing is you need to have the team captain in place and he knows what to do. Here, looking at the asset, the Kobada, they talk about having 50,000 ounces of production capacity in the 2016 feasibility study. They want to increase the inferred resources and place it into the measured and indicated resource, whatever they call it, into that category. And thereby they want to get to 100,000 ounces of production per year. There's also some mention here about shallow mineralization, deep oxidation. Oxidation is usually associated with, well, when the gold is oxidized, it's usually associated with having lower production costs. So that's a good thing to have in your project. They talked in the 2016 feasibility study about, as I mentioned, having a 50,000 ounces per year production profile, which would have led them to an internal rate of return of 43% at $1,200 per ounce gold. All-in sustaining costs $788 per ounce, which includes the capex and the sustaining capex. There is the current plan, which will lead to upgrading their resource, is this here, phase 1 pre-definite feasibility study assessment. They are planning to spend $2.5 million over 6 to 9 months. And after this, you can read here if you want what they're going to do. A very interesting word is this kriging. I have no idea what it means, even after reading the definition several times. Some statistical mumbo jumbo. And then in phase 2 would be the definite feasibility study, which they think would take 6 months and cost another $2.5 million. And with, of course, that they would then probably try to raise the financing to get this thing into production, which would be how they would see themselves progressing to a producer from an exploration company. We can see here their resource categories: measured and indicated 1.2 million, inferred mineral resource 1 million. As you can see, they have 1.1 grams per ton. Here in their studies, they found this to be the average, let's say, and any oxide deposits, from what I've read, is economical above half a gram, or even as low as a third gram. You can make money out of them because the metallurgy is very cheap to compared to other forms of mineralization. So looking forward, as mentioned, yeah, they want to increase it to 100,000, blah blah blah. Here's some more good information, some metrics. They mentioned it in the technical report in 2016, having an 8-year mine life. They're planning to increase the resource to 2.2 million, and that would probably it's almost a doubling. So that would explain this 50,000 to 100,000 plus. But then they would have to find more than 1.2 million in from the inferred category. They would have to exceed that to actually get to 100,000 ounces per year production without moving the number of the mine life. Because if they find more, then they can increase the mine life, and if they find less, they'd have to decrease it if they want to stick to that 100,000. So these numbers kind of moves. That's obvious. Average life of mine cash cost is very low, $557 per ounce. All-in sustaining costs, as mentioned before, 788, which includes a 45.4 million pre-production capital cost plus a sustaining capital expenditure of $36.7 million. Yeah, I think that's it for the presentation. I'd looked through the technical report. I actually read almost the whole thing. There was just two key things that really confused me, which was here this production schedule that they have here on page 121, where they talk about, for example, in year 1, 784,000 tons of ore mined, and then when you go a bit lower to page 155, you can see here that they have 951,000 tons of ore mined, and they use this here for their financial projections, and I kind of don't see why they have that difference. It makes no sense to me. The grades seem to be exactly the same, but it's just here somehow they expect to mine more, and I don't know why. So that's kind of a mystery to me, but I use this here to get to to do my analysis. Here I want to also highlight in their last quarterly report, they mentioned their administrative general consulting and personnel costs. You can see they're around $300,000 to $350,000 a year, not a year, a quarter, sorry. That comes out to 1.2 to 1.4 million per year. This is a key number to think about. Share prices, you can see here 25 Canadian, market cap of 15 million. And now to just get to my calculations, here you can see that in my financial section, there is here my revenue that I calculate based on the gold price, and I've put here 3 years as a starting point, that I think it will be in the 3rd year from now that they start producing, or at least start the construction, because as I mentioned, they have this pre-phase 1 pre-feasibility study, and well, phase 1 and phase 2 for the let's call it the technical academic work, which will take them a year and 3 months according to their projections. But let's assume it takes 2 years to get there, because it can always happen that the data is difficult to interpret or understand, and that's always a possibility that they don't meet the guidance of the timeline. So that's why I start with year 3 as the period from which I'm going to discount the cash flows. What else can I mention here? There's a bunch of options that I saw in their quarterly statement. Key thing is there's some that have expired, these in red, and then there's these ones here that are still valid, and you can see that these ones here at 90 cents for how much is that? Let me see. 9 million, yeah, almost 10 million at 90 cents. They are not going to be that relevant, but yeah. So yeah, to my present value calculation, I like to use a floor price of 13.50 to start with, and a 35% discount rate on something that I consider speculative. And exploration companies should be considered speculative because you have no idea whether they will get into production. There's so much that can go wrong. Yeah, at this price here, I have put in. I have not mentioned this yet, but I have to get back to that. Then right, do this first. So there was a private placement here, 2.9 million, which is why I have this 2.9, and then there's a $5 million placement here, and I added that into. This is for the funding, obviously, for those two phases, phase 1 and phase 2, plus the costs of running the business for the next year and 3 months. So of course the share count will increase due to that. This here is the shares associated with the 5 million, and this is with the 2.9 million. You can see here in the press release that they issued 14 million units almost, which is a share plus a warrant, which has an exercise price of 30 cents for 2 years. This 2 years is really important because that's how long it will take for them to complete their technical work. And well, not it will take, it's what they say it will take, and that would give the investors a 2-year period which covers that 1 year and 3 months to to benefit from their options. Same is with this 5 million placement here. They also have a 30-cent exercise price on the warrants. And another thing here to look at, and this is key, I think, is this 3 million stock options exercisable at 22.5 cents to expire in about 5 years from now, that the management gave themselves. And you can see they have they have a rolling stock option plan. But anyway, this is the key thing, that there's these options here that we need to use here to fully dilute the share count. And as you can see here, I calculated in US terms the fair value with these two key metrics to be 28 cents per share, assuming that they deliver. And of course, as I've said before, it's possible that they need longer to understand the data that they're going to get out of their pre-phase 1 and pre-phase 2. Not pre-phase, I always get that mixed up, but phase 1 and phase 2 of their academic work, let's call it. So everything, is there are moving parts. Fair value in Canadian 37 cents per share is what I get to. And of course, if you want to be like, if the data comes in and confirms everything, these metrics here will not be conservative anymore. They'll go to fair value. Let's say fair value is at $14.75, which we're currently at or above, and a 10% discount rate. You could be talking about $1.32 per share if they deliver. And if they don't deliver, it can just go so wrong. Oh yeah, I forgot here. I should have removed this because they're probably going to spend down this almost $8 million. Let's assume that they spend that down. So actually the fair value in Canadian would be 28 cents on a conservative basis. On a bullish basis, $1.22 fully diluted. Now, as mentioned, that will look attractive. Based on this, I think the share price is fairly priced, or a little underneath. Stock options are at 30 cents. There was a window to get in here at 16 or 17, 18 cents a share, which is below here. Of course we kind of passed that, but even at the current price you could still argue it is a speculation that has significant upside and limited downside. But as mentioned, it's a speculation. You can get creamed, you can succeed, you get good odds, 4-1. I think that's good odds. We have on the board, as I mentioned, a billionaire. Why is he taking over as CEO of a penny stock? Unless he actually sees huge potential here. And yeah, so I don't know, like maybe you people can give me some feedback whether you think that this has any chance to succeed, because even though I come up with these numbers here, they are all based on the 2016 production financial schedule. If that improves, then this should improve too. So yeah, I think that's going to be it for this video. Let me know what you think, whether you agree, disagree, whether you think I missed some things. Of course, I would not place any reliance on my data here, because I could easily have missed some stock options or miscalculated something somewhere. And that you have to always take into consideration, that there's always something that can be wrong in somebody else's analysis, because I made this here, and if you have not made it yourself, you should never rely on it. But yeah, this is my work. This is what I come up with. Let me know what you think in the comments, and don't just buy based on this. Have a good day.